From the Baker Institute for Public Policy at Rice University in Houston, Texas, this is Baker Briefing. I'm Ambassador David Satterfield. Baker Briefing tackles the most critical foreign and domestic policy issues of the day. Through conversations with subject matter experts, we seek to provide meaningful analysis and independent perspective. Each episode is recorded in front of a live audience at Rice University in Houston, Texas. Today's topic, consumer trends. I'm pleased to welcome my Baker Institute colleague, Joe Barnes, to lead today's discussion.
Thank you for being here today. The COVID-19 pandemic prompted an unprecedented cascade of economic events here in the United States, indeed around the world. These events included low employment, high inflation, and gigantic federal deficits. Some believe that we may face a looming recession. What role has consumption played in these events? Has consumer behavior changed? What should we look for in that behavior as we move forward? With me today are two of my economist colleagues here at the Baker Institute for Public Policy. I call myself proud to have known them for many, many years. They are Dr. Joyce Beebe and Dr. John Diamond. Thank you both for being here today. Joyce, let's begin by getting back to basics. What is consumption? And what role does it play in the economy?
So in a very high level, think about yourselves as consumers, and then whatever you spend, that's your consumption. And if you're collecting a paycheck like me, well, some of us, that basically whatever you don't save or put away for future investment, that's your consumption, because you spend that part of it. In terms of how important that is for our economy, well, let's think about a very common term that we hear every day in the press, or think about the way back in your high school or college economic classes, how we measure the size of the economy. It's basically called GDP, the gross domestic product. It is basically to say, well, how large or how small is our country's economy? So consumption is actually a pretty important part of that GDP. And the economy can grow, expand, or it could shrink during the recession. So think about a pie. There's a piece of pie. The pie may grow bigger or smaller. That's the GDP. So GDP can be bigger or smaller. But consumer spending, or the role of customers or consumers, it's always very important part of that piece of pie. So in terms of the size of the GDP, consumption GDP, it's roughly 2/3 of that pie. It's pretty consistent over the last several decades or so. Consumer, therefore, plays a very important part in terms of the GDP.
Yeah. Now, Joyce, I'm going to follow up or move into a slightly different area by asking you an impossible question, but you're excellent at answering impossible questions. Could you give us a quick snapshot of the U.S. economy since COVID struck?
I'm going to take everybody back through the memory lane about what happened in March 2020, and I'm sure everybody has their own COVID story to tell. And I'm going to share 5-second or 20-second version of how the COVID started with me. I was walking in the park and I received this email in March 2020 from Rice University. I was teaching a class for Rice at that time, and all of a sudden I got this email that said, hey, all the instructors, get ready to move all your lectures online. We will give you a week or so to do that. So in a week, everything will be on Zoom. We'll have these resources like link A, link B, link C, so reach out to us if you have any questions. Best of luck. So everything goes from there. It's my first impact from COVID. And then my kids' school closed, and then everybody started this term called social distancing, which we all know too well at this point. But how do you kind of put all that in economic terms? Like Joe mentioned, in March, the unemployment rate shot really, really high, unbelievably high. And then there's all these government responses, and then we know this term called PPP very well right now. That is the Paycheck Protection Program. Every employer in this country try to see if they can qualify for the PPP loan, so they don't lay off their employees. And then there's the UI, unemployment insurance, and the federal government kick in to extend the program. And of course, we all heard the story that there's an overload of the UI system, including the Texas state government, that has all this influx of unemployment application. Then the government responded with some more. There's mortgage forbearance, student loan deferral, which means you don't have to pay for a very long period of time. And all these stimulus checks, and slowly we all got locked up state by state. So there's all these things, very unpleasant memory. And then what happened next? We can't go anywhere. We had to have our groceries delivered. We don't travel anymore over a very long period of time, I should say. And then we reopened in, say, a year later. All the customers, the consumers decided, well, I'm going to travel and we are going to go out and spend again. So the recession is very, very short because all of them went out, consumers went out, started to spend money and decided to travel again. So the recession is one of the shortest or the shortest in the US history. Finally, we see the high inflation and we're still experiencing that. The Federal Reserve then kicks in with great rate increase. So we're not really done with Federal Reserve increase. But Joe, this is over the last couple, 3 years, what happened?
John, during this period, I think Joyce talked briefly about a sort of pattern of withholding expenditures and then using them. Do you have any thoughts on how consumer behavior changed during this unique historical period?
Yes. So I think we saw two major changes in consumer behavior. The first, which we've referenced, is consumers started to purchase a lot more of their goods online. They couldn't go to stores. You couldn't go out to eat. And so we were all getting to-go food. And you would just call in and go pick your food up or have it delivered. The grocery stores had all these time restrictions. And so a lot of people were just getting their groceries online and they would either pick them up or having delivered. Everything else we would buy, people were buying stuff online at a much higher rate than they had before. That seems to have stuck. A lot of that seems to be the new norm as opposed to reverting back. Now, there was also this phase where initially in the pandemic, we had to make our house into an office, into a gym, and several other things. And
into a school.
A school, yes. I taught my kids in their rooms. That was the new school. So we had the composition of consumption change drastically. Initially, we quit buying services and we switched all of our consumption to durable goods. And that lasted until we got to this period when things started opening back up, and then we had to revert back. And so that transition is not the new norm. We had this period of very high consumption in durables, very low consumption in services, and now we've been shifting back. We went through a period where it was higher services and lower durables, and now we're returning to a more neutral composition between durables and services, although as we are on that path, we then run into this ugly thing called inflation, which the Fed starts to raise the interest rates by almost 5 percentage points, which causes a shift in how consumers view certain very large durable goods, specifically housing. So we're in a period where people are reluctant to buy housing, and so we'll see how that plays out over the next year and a half. But as for now, spending on new houses, it has been down for 12 months in a row. Those expenditures are being shifted elsewhere. We're right in the middle of that cycle.
Now, the change to e-commerce, right, the shift toward, that's one phenomenon. Another phenomenon you mentioned is the working at home. How durable do you think these phenomena are going to be? I'm sure the percentage of each will go down, but will it ever return to pre-pandemic levels?
Not at all. When you look at the data, the e-commerce is not going down. It rose up and it is pretty flat where we landed. And I think we're going to stay there. Although the more comfortable people get going to stores when they feel more comfortable health-wise, which I think all the data shows that more and more we're getting very comfortable. It used to be that you just went to the store. Now it's that you shop online and you find the best deal and then you go to the store. So there's some combination. But for the large part, the new normal of much of our goods being purchased online is going to stick. Working from home, look, I dress very different at home than I do at work. I don't wear my suit at home. I'm in athletic clothes because I'm ready to exercise at any moment. Then I don't. But that will also change consumption patterns. And I do think the work from home is going to stick at about right now we're sitting at 65% are going in the office and 35% are either home or have some type of hybrid schedule. I think that's where we've landed and that's where we're going to stay for a while.
Dr. Beebe, one of the key components here in terms of consumption is like credit card use. What have we seen in that market or that sector during the pandemic? I know you're an expert on this subject, so I feel comfortable asking you it.
There were really good statistics compiled by the Federal Reserve research about this. So as of sometime late last year, they realized overall credit card application has returned to the pre-pandemic level. So consumers are really comfortable going out and apply for credit again. But if you go a little bit deeper on that story, they look into the people who have higher credit scores versus lower credit scores. And people who have higher credit scores, if you segregate that way, their application for credit card has even go higher than the pre-pandemic level compared with, say, today versus pre-pandemic. But the people who with lower credit scores, their level of application has not really returned to that level yet. So you see this slightly different story over there. And there are some also statistics saying that the credit card balance has really increased. And if you consider how high the interest rate is these days, that's a really interesting phenomenon to watch.
Now look, in a recently published paper that's on the Baker Institute website, you used the term revenge spending. What is revenge spending?
So I want to say that this is a really interesting term, but I don't want to take credit for that term. It is from a lot of newspaper articles. You've probably seen that before. So I borrowed this term to describe the fact that consumers have been cooped out for a really long time. They really want to go out and take that for the last 2 years of time at home. But how do you kind of put these in the economic terms, like Joe mentioned, was that I want to kind of direct everybody's attention to another Federal Reserve research, which I think paint a really good picture about this. So they say, well, if you think about how consumers spend and how much they save pre-pandemic, let's say 2019, and use that as a baseline, that's basically like COVID never happened. And look at today, COVID happened, and what's the difference in terms of consumer saving level? And there's all these extra saving that consumer has done because of COVID, and they call that an extra saving as a result of COVID. So between March 2020 to say summer 2021, that pile of extra cash, it's about $2.3 trillion, according to the Federal Reserve. And sure, the economy reopened as of that time, and then for the next year, between 2021 summer to 2022 summer, consumer has started to de-save. They start drawing down their extra saving, and they probably draw down approximately about 20% of that pile of cash. But there's still a large chunk over there. And the Federal Reserve basically said, well, that's what's supporting the consumers at this point. And basically, if you look at consumers at the top 50% of the income level versus the lower 50%, the top 50% of the household has more extra saving than the bottom 50%. And that ratio is about 1 to, say, 3.5. So that's the distribution right there. So there's still a big chunk of saving out there to support the consumers.
John, let's talk about unemployment for a bit. Unemployment spiked to very, very high levels, and then it declined to very, very low levels recently. Why?
So the initial spike is easy to explain. No one could go to work. But as Joyce pointed out earlier, there were a lot of government stimulus programs that encouraged employers to keep as many employees on the payroll as possible. Employee retention credits, PPP, all of that. But inevitably, when you shut an economy down, you're going to get large unemployment numbers. And that's exactly what we got. It spiked to almost 20%. And then came down almost just as quickly once people started feeling more comfortable with opening up. Now, the second part of that story, so why is it so low now? This is just your basic demographic issue that we've been dealing with for a time. We have an aging population. That means we have a lot of older workers at the end of their working life. They start retiring, and that's driving the labor force participation rate down, i.e. the percentage of people that are able to work and the percentage of people that actually choose to work. Out of the total number of workers, that number's been falling, and it's going to continue to fall every year. But that means that labor supply is falling. If we look at CBO data, it used to be that CBO projected labor force growth to be around 1 to 1.2%. Their latest projections are that labor force over the next 20 to 30 years is going to grow at 0.4%. So we have a much smaller labor force growth rate. Therefore, it's easier to employ them all than it would be if we're adding a lot of potential employees to the economy.
Now, Joyce, we talked a little bit about unemployment, but there's another huge economic reality out there, and that's inflation. To what do you attribute the sudden jump in inflation? And what is the Federal Reserve doing about that jump in inflation?
Fair question. So everybody experienced inflation, and there are several reasons that cause that. So we already mentioned that consumers want to chase all these services and goods. We want to buy things. We want to enjoy services. That's one. And we have all this money. And if everybody remember in the early part, or just not so long ago, we had these semiconductor chip shortages. And then we don't have enough cars to sell, we don't have enough TVs because there's not enough chips to make those goods. So there's a supply chain issue there, and supply side of the things too. And also don't forget about the geopolitical issues, about the Russia-Ukrainian war, which created increase of energy prices. So a combination of issues caused the increase of high inflation. And as to what Federal Reserve is doing, we all see the rate increases. And I like to share one interview I read, which is given by Larry Summers. He was the former Treasury Secretary. So people asked him about the Federal Reserve's action about this raising interest rate, and will it work? How long does it take it to work? And he said, well, you know, there's always going to be a lag. Think about yourself going to an old hotel room and you're trying to take a shower. You turn on the faucet, and because the pipe is so old, you cannot get the temperature right away. So it takes a while, it's too hot, it's too cold, and then finally it's right. So he said that's a good analogy for the lag of the Federal Reserve's interest rate increasing policy. It takes a while for it to work, and we're not done yet.
Okay, now look, we're coming, unfortunately, to the end of the podcast. And I'm going to throw out a question for both of you. And I'm asking you to put yourself in the place of the average consumer in the United States. How should the average household, the average individual, how should they look at the economy going forward in terms of their own consumption? I know there's a lot of difference in individuals, but what do you think, John?
So I think consumers need to be aware of a couple of macroeconomic factors. One is the persistence of inflation. What that means is the Fed is probably not done raising interest rates. In fact, we're seeing data each month that this could be true. The latest inflation data would show that there's a little uptick. We're going to get more data in the personal consumption expenditure numbers, which are either going to confirm the numbers from a couple of weeks ago, or it's going to cool those numbers. And that's going to be really interesting to see. So consumers need to be prepared. So I would say they need to start saving, and they need to save for two reasons. One, if the Fed has to continue raising interest rates aggressively to bring inflation down, then that's going to raise the probability that we have a recession. There's no certainties. It's either likely or unlikely. I'd say right now the probabilities are 50-50. If the Fed has to continue to act, then the probability of recession is going to increase. The second thing is we've just gone through a decade and a half where cash was trash. The last thing in the world you wanted to own was cash because you made zero on it. There was no return in CDs. There was no return to bonds. Put your money in stocks and you were going to get a great return as the Fed continued to buy assets. As the Fed's balance sheet went from $700 billion in 2008 to $9 trillion in 2019. It was just perfectly made time to buy stocks and get a good return. But we've left that world. Cash is no longer trash. You can get 5%, 5.5% on a treasury. Consumers need to think about saving for the future, and I would be saving some of that money in high yield money market funds instead of putting it all in the stock market.
Joyce, do you have anything to add?
Not much, but I'll try. I like this episode because it's very timely. The Federal Reserve and everybody's extra saving that story, if you kind of think about that, the American consumers are not in trouble yet because they still have this extra saving that's not totally disappeared yet. But if you really think about the upper part of the household, 50% in the Federal Reserve study, and the lower part of the household, their extra saving generally come from different sources. So the lower 50%, their extra saving generally come from government stimulus checks, all these government assistance, UI, all those assistance programs. And they not only came earlier during the pandemic, they also has finished. Governments already terminate those programs. So those households will no longer have extra saving coming into their balance sheet. Not only that, they also have a smaller pile of cash to spend. So if you think about the upper 50%, their extra saving mostly come from the stock market. And that doesn't really realize until, say, late 2021 or mid 2021. And their housing value increased. And these households in the upper part of the income distribution, they not only have bigger pile of the extra saving, they also have not spent down as much as the lower 50%. So if anything, I can provide advice, I would say average consumers or people who are toward the lower portion of the income distribution, I think they need to take action earlier than later. But we're not in trouble yet, which is a great time to start acting, saving more, like John mentioned.
I think we're unfortunately at the end of this episode, but I would like to thank you both for what was, at least to me, a very, very informative discussion.
Thank you, Joe.
Thank you, Joe.
Baker Briefing is brought to you by the team at Rice University's Baker Institute for Public Policy. This episode was produced by Victoria Jupp and Shannon Moriarty. Planning support was provided by Serena Storm, Joelle Paulson, and Sean O'Neill. AV production was led by Kevin Young. Many thanks to the Baker Institute production interns who assisted with this episode: Maya Adhikari, Sarah Davidson, and Lisa Jacob. The Baker Institute for Public Policy provides meaningful policy analysis on the most critical challenges facing Texas, the United States, and the world. It is a nonprofit, nonpartisan research organization based at Rice University in Houston, Texas. To learn more, including how you can attend a live podcast recording on the campus at Rice University, visit us at bakerinstitute.org. Thank you for listening.